It's been a bit of a ride for Melbourne real estate over the past several years as it comes out of the doldrums of one of the longest COVID lockdowns in the world. There is a level of uncertainty that is keeping investors and other businesses sitting on their hands, waiting for signs of stability. But at the same time, there are many reasons to be enthusiastic. There is an undercurrent of optimism. All it takes is a bit of a deep dive to see where it is coming from, where it is showing already, and the reasons why. A JLL report entitled The Real Melbourne did just this and is worth a download from jll.com.au if you haven't seen it already and you are invested in the city. We're going to do this deep dive in human form today with my JLL colleagues Peter Harper, Managing Director and Head of Investment Sales in Hotels and Hospitality, Annabel McFarlane, Head of Strategic Research, and James Jorgensen, Head of Logistics and Industrial in Victoria. I'm Rebecca Kent, host of this Perspectives podcast, of which we will be doing a few episodes actually that spotlight Melbourne. Thank you for joining us, Peter, James and Annabel. So Peter, we'll start with you. Think back, I guess, to the start of 2024. What eventuated as you expected? First of all, and then tell me, where would your bets have fallen short?
I think 2024 played out almost entirely unlike what we were hoping or thinking it would, but then in many ways it also playing out like we thought it would. I think going into the beginning of this year, we'd gone through 13 interest rate rises, whatever it was, over the course of 2022 and 2023, and there was a view that the veracity in which the RBA made those decisions and put the cash rate up to where it still sits was going to have a fairly immediate and sudden impact, and then we were going to see things, the economy moderate and things certainly improve over the first half, and then second half we'd see liquidity really sort of kick off again, and in many ways we'd be back into the recovery. That didn't happen at all. I think things definitely stayed quite passive across the board. I think most investors took stock of where the world was at, where the markets were at, where debt was going to go. So we just saw very little transaction activity. I mean, the activity that we saw coming out of COVID, was obviously fueled by cheap money and people in hotel world wanting to take advantage of the domestic tourism boom that was happening and so on. But I think in many ways 2024 has proven to be the year that we sort of had to have, and hopefully a bit of a reset, and 2025 is much better than how we found the last 12 months.
From an industrial perspective, I think we'd had such a few boom years during the pandemic that it probably was inevitable that we'd have a correction or a normalisation of the market. But it was pretty stark difference this year to what we've experienced in the last few years, and definitely discretionary spend has a direct correlation to the need for industrial space. And as spending dried up, so too did the demand for industrial space. So I think, if we look at from an occupancy perspective, the West market's the biggest market in Australia, and it will probably do about 30% of its 3-year average leasing volumes this year.
That's pretty drastic, isn't it?
Yeah, it was a bit of a shock to the system for most industrial brokers out there.
It is a shock to the system, but I just want to say that, Melbourne, we still had, for example, the most recent quarter, 41% of all national gross take-up. So it is across the board still one of our strongest markets, even though it just got a little crazy there.
Yeah.
It got very crazy there through the pandemic.
Yeah, it got crazy through the pandemic, it did. And I think it's definitely normalised. Like if we look at vacancy rates, they're at a normal level, but when you're coming off sub 1%, it feels like, there's a massive oversupply. And I guess the demand, that's probably the big thing in the industrial market this year is, we're largely driven by third-party logistics occupiers, and they're driven by consumer spend, and less inventory coming into the country means less warehousing and less need for 3PL space. During the pandemic, they were all taking on space speculatively, more and more, bigger and bigger buildings, and as their businesses have come off, they're now sitting on vacancy within their existing sheds. So it means even when a new contract comes up, it's not resulting in them taking new space. They've got enough white space in their existing portfolios.
So it must feel, I guess, daft to some people to still be talking about COVID, but Victoria is probably one of the markets that can justifiably still talk about the impact of lockdowns because, it's still, I guess, reverberating. Is that fair to say?
Well, certainly in the office market, it's quite interesting. We've done some stats quite recently around return to office, and there are certain parts of the CBD market, for example, that the return to office story has stabilised, but other parts of Melbourne where it's still increasing.
And that's, for the hotel market, and I've spoken about this a little bit before, as we came into COVID, Beck, the Melbourne hotel market was embarking on the largest new supply wave we'd ever experienced. And then so when we went into that drastic lockdown the way we did, we had the biggest room night demand shock the market has ever experienced. Hotels essentially closed overnight unless they were doing quarantine business. And then as they started to open up, and bear in mind there were hotels that were closed for 6, 12, 18 months, we saw all of these new hotels start to finish because construction was one of the only industries that was allowed to operate through that period. And so when the market came back on, not only have we just gone through the biggest demand shock, so there was almost an entire reset of the market from that perspective, we had all this new supply to contend with. So a lot of hotel owners and operators are sort of working through that new normal. It's pre-COVID, we were running at sort of 82, 83% occupancy at an average daily rate of about $192. We've now got an occupancy rate in the early 70% range, but an average daily rate well into sort of the $230, $240 mark. So it's just,
different metrics.
Different metrics completely. Certainly from our perspective, people getting their head around the new normal was...
I think the supply wave story is so interesting because, in office, I don't think people realise that we had the CBD through the pandemic increased by 12.2% in office stock. If you include the fringe, we have added 1.1 million square metres to Melbourne's office market through the middle of a pandemic. Really the timing couldn't have been worse. Those buildings now, those ones, are largely, fully occupied, or they've certainly got low vacancy. The ones that finished later, some of them have been more challenged, but fundamentally it's the better assets have reset the market.
And I think too, Beck, just another thing to add to your question, and certainly I'm not sure if it's the case for the industrial market, but in hotels we've been so heavily reliant on foreign investment into our market. It sort of characterised activity for certainly the 2 decades of my career. But the way the Australian market is set up, it's very hard for people to get put into receivership. Banks necessarily don't want to do that. It's a smaller market, so there's enormous pressure on valuers to hold vals as best as they can because they're working with a limited client base, limited transaction activity and so on. So the market just hasn't reset the way we have seen other markets, particularly in UK and Europe and parts of Asia and North America, where it can just turn on a dime. And so we've had, certainly in the hotel space...
Admittedly, their volatility in economic volatility has been greater too.
And they're used to that.
Whereas we haven't had the economic volatility either.
We almost suspect just this linear growth in all of our markets. But a lot of investors, and I've been up in Singapore every 2 months for the last 2 years just trying to take stock and meeting with all the owners up there and all the investors, and they're like, listen, we still love Australia, and it's not just isolated to yes, it is a Melbourne story to an extent, but we are seeing similar themes play out in Sydney and Brisbane and so on. They're like, while you're going through that stabilisation, recovery, reset sort of thing, we're going to go to markets where it's happened a lot quicker. We see really compelling value and we're going to take advantage of those opportunities. And once we've done that, then we're going to come back to Australia.
So have we been at somewhat of a disadvantage for being sort of economically stable for such a long time?
I just think that, the inflation figures got much higher elsewhere. The cash rate got higher elsewhere and it's come down quicker. There's more extremes, I think, perhaps in other markets. And that's a bit of a gross generalisation, but we've had a very sort of we've had no change to the cash rate in
November 22.
Yeah, so for full year, just over 12 months.
Longer.
Yeah,
Much longer.
much longer.
2 years.
2 years, exactly. We have a lot of forecasts out there. The market's always forecasting it's going to come in, it's going to tighten again, and it hasn't happened yet.
So, Peter, for the investors that have been sitting on their hands, I suppose, and, you're talking about the Australian market being so heavily dominated by foreign investors, maybe tell us about the ones that have been active. Where are they playing? Where are they finding value for themselves? And who are they?
They haven't played much this year.
There's PAG invested in office, in CBD office.
Yep.
367 Collins Street. There are a couple of examples, very few in Melbourne now, very few yet.
Yeah, but office transaction
Syndicators.
volumes, what are they sitting at this year relative to historical averages?
Negligible.
Yes, yeah. Okay. And that's...
they're way down. I haven't got the figure, but they're way down.
Yeah, and that's the same for hotels.
Yeah,
there are
a couple of examples, but not many.
We'll fall well short nationally of the historical long-term average in terms of transaction volumes. You look in Victoria, there's 4 or 5 deals. Like it's been pretty soft, pretty quiet this year. I think some of the deals that have happened though, and there's been a couple of themes to that. I mean, we saw Siebel Ringwood transact earlier this year. Now that's something, a thematic that I think we're going to see play out a little bit more with developers that built all this new stock. A lot of it came about because the hotel benefited a mixed-use development. They put a hotel in there because of the halo impact it had over the residential component or the commercial or the retail. Some just got into hotels because at the point when that development was conceived, the market was strong and there was an opportunity. But they've sort of got to the point where I've taken this as far as I want to go, and I'm not a hotelier, I'm a developer, I'm out. And so we saw that transact quite a strong price ultimately, but it had to be a real structured deal to get there. Now that was bought by a local fund that had Malaysian money. We've seen the Adelphi Hotel transact, and now that was probably the only real receivership deal that's taken place. We sold that to a group about this time in 22, for 25 million, and then we resold it again only a couple of months ago for 20. 21. There's a bit of a discount there. So, we are seeing some of those standalone privates feel the heat of the cost of debt and so on. And then we've started to see a couple of transactions acquired for redevelopment into the living sector, whether it be co-living or BTR and so on. But for the most part, all of that capital is domestic-based, or certainly domestic-led, even if they do have an offshore partner.
If you look at our office market yields, for example, the interesting thing is the difference between all the markets now, because in Australia, typically Melbourne and Sydney might have the prime CBD office market yield spread would be 44 basis points over the last 20 years. That's the sort of standard. It's currently 82. So at some point, it's going to look like good value in Melbourne.
From an industrial perspective, it's been a similar theme. We've seen there's been an incredible appetite from offshore capital for the last 5 years, where they've basically bought everything. However, the introduction of an additional surcharge to the land tax has basically led to all offshore capital sitting out from now. So the only transactions of note this year have been to local super funds.
Yeah, super funds have gone in big, haven't
super
they?
funds have gone in. And it's also probably allowed some owner-occupiers to get back into the market. For the last 5 years, they haven't been nimble enough or been willing to pay enough to compete with these offshore institutional groups. But with them all sitting on the sidelines for the time being, there's been an opportunity for owner-occupiers.
Now, they're sitting on the sidelines, or they just can't compete?
Can't compete. Yep. Reckon it's probably a 75 basis point penalty when you load in the additional surcharge.
Can someone just elaborate on the land tax? Because that's had quite a massive impact across sectors, hasn't it? Just for those who don't know.
Probably has the biggest impact on industrial because it's the highest land component compared to the building. So it makes a big difference. You're buying a parcel of land that has 50% building ratio on it compared to an office block where the component of land's tiny.
There are 3 things to it, actually. What's happened over the last 2 or 3 years, we've had land values escalate enormously, triple and double in some precincts. That's one driver of increased land tax bills. The next thing is they've changed the rates of land tax. And then on the top for the offshore groups, they've got this 4% surcharge, and that's gone up from 2%. So now you've got three big drivers of big changes to your land tax bill. And whereas it would be quite sort of manageable, I'm sure you're seeing a lot of discussion with tenants about who pays it.
The outgoings, yeah. That's another big point.
Who pays it? Because traditionally it would have been the tenant just, takes it on the chin.
Well, I think most leases would be written in a way where the tenant does have to take it on the chin. However, it's become quite a competitive market. Again, it's flipped to a tenant's market. So to remain competitive, a lot of the landlords are choosing not to pass it on for the time being.
For the time being, yeah.
What sort of policy shifts or levers would you be pulling if you're in the seat of power to, I guess, get things moving again, if you could, next year, Pete?
Look, we had Nick Rees speak at a private client event that we did a couple of weeks ago, and he made a really good point. I think this is the first thing I'd do if I was sitting in a position of power in government, is bring the public sector back into the office. And, the impact that would have on the leasing market, the office market, even the retail market in terms of demand for cafes and shops and everything else, absolutely. I think that's a no-brainer.
I think the other one that Nick actually came up with, which is that economic zone
Yes.
around the CBD, which is not a bad idea, for special dispensation to get the CBD moving again, because we've got to get, we want to get the CBD moving because that's the engine room of Victoria.
100%.
Really.
And look, Melbourne became the largest office market in the country, the largest hotel market in the country.
It's the largest industrial by a country mile. It's 29.1 million square metres, 41% of all, the largest by a mile.
And that all came about because we welcomed investment, we welcomed development. A lot of people used to favour, a lot of developers in particular would favour Melbourne over Sydney because you can get a building approved and construction going in, 12, 18 months, where it's multiple years in a market like Sydney. People came to Melbourne because they could put their money to work, and it was a happening place. And so many things are still happening, particularly from a hotel sense. We still have a thriving major events calendar, and we're continually selling out concerts, and population growth is strong. Corporate demand is still there. It's still a really good place to come if you're a domestic or international traveller to come and visit. But we're just not doing enough to promote development and investment the way we used to.
I think the structural fundamentals, as we know, that population growth story, it's people talk about it a lot for Victoria, but it's really material. In the next 10 years we'll have, give or take, because these forecasts change around a bit, but 900,000 more people over the next 10 years. Only Delhi, out of the top cities in the global 15 economies around the world, outperforms Melbourne over 10 years. New York is expected to outperform Melbourne over 5 years, but in 10 years, Melbourne will have absorbed more people than New York, London, Berlin, and there's a whole bunch of other cities in the global top, 15 economies around the geographies around the world that are actually going to be losing people. And given that we all shop, need goods delivered to our homes, we have visitors, need hotel rooms, we need, places to work, albeit that's changing slightly. It's an incredible driver for all real estate.
It's an incredible stat. Just out of interest, how does that compare to Sydney's population growth numbers?
Sydney gets, over the same time frame, the 10 years, Sydney gets around 500,000, Brisbane gets around 500,000, and Perth is a little less, 460,000. I think we forget that. It's like, when you were talking about cold storage previously, we're all doing more take-home meals, we're doing more eating.
Yeah, you just walk through the supermarket and you see the amount of frozen space in a supermarket. I remember you used to get half an aisle, and now it feels like there's 3 aisles dedicated to pre-done meals and frozen space. Yeah. Which we're seeing in demand for frozen and chilled logistics space. It's one of the big drivers of the market at the moment, are the big third-party logistic groups in specialising in frozen and chilled.
If you compare us to the US, I think on cold storage we're underdone per capita. And if we've still got a a population growth story as strong as we have across Australian markets, then that's a good news story for cold storage.
Yeah, well, the population growth story for the industrial market's terrific, and that's what we're telling occupiers and landlords. The fundamentals in Melbourne are terrific. You've got double the population growth to Sydney and Brisbane over the next decade, and we know that there's a direct link to warehouse space with somewhere between 4 and 6 square metres per person. So I think in 10 years' time we're going to need 2 million more square metres of warehouse space just to cover population growth. And when you couple that with the penetration of e-commerce, which we think's got a decent amount of headway, you add to that again.
Just going back onto industrial for time, are we seeing much like when do you start to see sort of things, you're saying it's a tenant's market at the moment, when do we start to see things balance out? And then on that, population growth point, do we then start seeing a more of a speculative development wave come through or pre-commitments? I don't know, how do you see that sort of panning out? Good
question. So the COVID years, there was so much demand. We're in a tenants market now because there's been a big wave of spec supply delivered this year in response to the COVID demand, and it's arrived at the time that demand's really softened. This year was soft. I think definitely the first half of next year will be soft as well. But now that the supply's been delivered, developers are reluctant to bring on more. So we'll slowly see this current wave absorbed. Then we'll start to see some sort of normalised rental growth again. And then I think more spec supply will be sort of drip fed rather than blasted out like it's been in the last 12 months.
And this change has only happened sort of fairly recently. Like rents have been on a bit of a ride.
Rents probably doubled in the space of a 5-year period. So there's plenty of tenants who are coming off long legacy leases who are getting a really rude shock when they come back to the market or go and renew leases. So that's stimulating a little bit of activity. However, I guess this year it's flipped back quite quickly, and landlords are now favouring renewals to avoid their buildings going into the oversupplied market and competing with new spec stock. So we had 300,000 square metres of speculative development that's been completed in the last few months in the Western market. So that's meant that landlords of existing buildings are having to do pretty good renewal deals to avoid competing with the spec supply. So rents moved really, really quickly, and then it's flipped back quickly as well.
Peter, you were talking previously about hotel conversions into build to rent and other types. Can we just go into that a little bit? And maybe Annabel as well, it'd be interesting to hear a little bit about how that might be happening in the office sector also, where and why and how that shifts the landscape a little bit.
Yeah, well, where that's come about, the Australian hotel market has been characterised largely by a couple of fairly significant development booms over the period. We had the Japanese investment in the 80s that delivered us a lot of product. We had a lot around the Sydney Olympics in 2000, and then again, just what we've gone through. So many of the original hotels in Melbourne in particular have been in existence now for the best part of 40 years plus. They occupy really strong locations and really significant land parcels. The challenge that a number of these hotels have faced over the last couple of years is because the Melbourne market was running at such high occupancies for so long, there was no incentive to shut down your hotel to renovate or refurbish. And so once we went through COVID and again, that huge demand shock, coupled with that enormous supply shock, I mean, what are there, 6 hotels remaining under construction in and around the Melbourne CBD. And once they've come online by, call it the end of next year, perhaps sort of early 2026, we're looking at a total increase in room night supply of around 33%. So it's significant. But a lot of those hotels, as they came out of COVID, went, you know what, we just can't compete. There's so much better product in better spots. And you know what, particularly with the activity and the value growth in the living sector in particular, you know, that I think fair to say was certainly one of the buzzwords of the commercial real estate sector for last year and this year. They got to a point where they're faced with, I either spend a ton of capex on my asset that's purely defensive just to ensure that I can continue to compete in this market, or you know what, I take my chips off the table. I recognise that the fundamentals of not only the plot of real estate that my asset is situated on, but in a lot of cases, the built form characteristics of the asset too lend themselves really well to conversion to co-living or BTR in particular. And so we've seen a number of assets transact in Melbourne over the last 24 months that have been bought for either conversion or redevelopment. So it's not just isolated to Melbourne, but look, in a lot of ways, it's presented a real opportunity for some of these owners that otherwise, if there wasn't that strength in that living sector, would have found themselves to be in a little bit of a pickle. But they've got out at really strong prices. It's helped us meet the needs again of that, you know, requirement for residential accommodation or student accommodation, even as we've seen at times. And then it's taken out some of that supply in the market to, again, help the market recover as well it has. I mean, I referenced that low 70% occupancy rate for the Melbourne market. That's enormous for a market that's had to endure that level of supply. And so that speaks volumes, again, to the fundamentals of the market. But it's only a good thing if we see more of this older stock, hotel stock, come out of the market and help us as a city and a market meet the needs of particularly BTR, but also co-living and student accommodation.
I mean, the office market is not quite as easy with office. We haven't seen that shift to other asset classes. It just isn't as easy. But what we are seeing is that those groups that are refurbishing their buildings, you know, upgrading, whether it's the sustainability metrics and the end of trips, that they are doing better than others. We've done some work. We've been looking at the vacancy across the CBD of Melbourne, for example. It hit 20% in Q4, 20.1%, which is high. Not quite as high as 1993, but it's high, and it's a real challenge for the market. But even in the context of that, we are seeing some assets record positive effective rental growth. Not many, but that's a really encouraging thing. And what do they have in common? They have great location. They have great building amenity, great precinct amenity, high sustainability metrics, and a proactive, owner or landlord. And on the flip side, we've got 60% of Melbourne's CBD vacancy sitting in just 38 assets, or 10% of the market, and it's a lot of vacancy. And if you look at those assets, you can put them in. There are four categories that seem to be their challenge. Their challenge sometimes is they're in a weaker location. Okay, that's difficult to fix if it's a weaker location, because you have to then start looking, well, is it office? Is it something else? The next thing is that some have been exposed to very large corporates who happen to have been the corporates that have shrunk. Office assets work really well when you've got lots and lots of tenants. If you've got one huge tenant which decides to vacate or shut, you can get really caught out. And that's a couple of situations have happened that with the big corporates. So that's one sort of bucket. And then you've got the ones with the building condition is tired, old, and it needs to be upgraded. And then the fourth bucket is the ones that have the same issue, buildings tired, old, and upgraded, and a landlord that doesn't want to do anything. So we think that the first, those middle two categories, they have plans. They will refurbish, they will get going, and the vacancy in those will be absorbed first. It's the ones where you've got landlords not doing anything. There's no price at which some of these tenants will think that's a good idea. Good idea. When you're a 5,000 square metre tenant in the CBD at the moment, you get 52 prime grade options thrown at you. Yet, if if you are a prime grade, a tenant that looking for 5,000 square metres, you might find that there actually only are 3 options that you would even consider, and you'd rather stay where you are than move to some of these other cheaper options.
And is location a big driver in that too?
Massive.
Yeah.
It's the eastern core of Melbourne seems to be where it's this positivity is starting. It's rippling out to Civic, down Collins Street, across to Parliament. It's sort of centering around that location. But we've got some of those assets. If you wanted to get into 101 Collins Street and you're 5,000 square metres.
Get in line.
Yeah.
Take a ticket.
Exactly.
Yep.
So some of the better assets are very quickly filling up with the tenants that manage to make their decisions quickly. And I think a lot of tenants don't realise that. There is a lot of choice, but a lot of choice in stuff that you potentially don't want. So we think there's going to be a structural vacancy basket in the CBD for some time. Vacancy will remain high, but some assets will start to benefit.
It's the exact same thing with the hotel market.
Yeah.
The basket data or trading metrics don't look
great.
It's not horrendous, but it's not great either. But if you dig a little deeper, there's a real bifurcation of the market. You've got the best stock, be it location or quality. They're flying. They're trading really well. And again, I was up in Singapore last week. There's so many owners that are just enormously happy with their asset in Melbourne. But then there's that other stock that's in secondary locations or it's, really poor quality. They're struggling.
Are you seeing any similar patterns in terms of location in the industrial market?
Yeah, it's a good question. Historically, the industrial market has operated by way of tenants moving further out to sites with cheaper underlying land values for cheaper rent. However, I think particularly the larger occupiers are becoming more sophisticated, not necessarily doing that anymore, are now doing much more analysis on transport costs and costs other than rent, and will commonly take a view that cheap rent in a bad location is probably a bad deal, not a good deal.
I think we've canvassed a lot of the market really well. Thank you so much. Just one last question before we go. I'd be interested to hear from each of you a last word on what the biggest trend you think will unfold in your respective sectors. So Annabel, let's say offices, James, industrial, and Peter, hotels. And at what point in time that will have the biggest impact and what will the impact be? So one trend in each of your sectors, when will it have the impact and what will that impact be?
Going into 2025 for the hotel sector, I think it'll be the value of the Australian dollar. I think where it's sitting with Trump coming in, everything that he is going to do, I think we'll see the growth of the USD. So what that means is outbound travel is probably going to moderate. People will elect to stay home and travel within Australia because it's just so expensive. But the States, Europe, Asia, a lot of our key inbound source markets, there will probably never be a better time to travel to Australia. So I think that's really going to have a real positive impact on hotel trading over the course of 2025. And there's the obvious flow-on effects to what that means for investment as well.
I think in terms of office, I think the trend we'll be keeping an eye on is Sydney's had a very positive net absorption figure for 2024, which is great. The vacancy numbers for the national vacancy numbers for office, CBD office, is coming down. I mean, it's not in Melbourne yet. So we think Melbourne's positive story will start at some point in 2025. I think the other story that I think we have to be very aware of, particularly for office, is the sustainability reporting standards. They're coming in 2025. We've got the international valuation standards. That code is coming in 2025. We've had neighbours start to have come out with their embodied carbon tool. So that's going to shift, I think, thinking around refurbished assets, and while we've got high vacancy, that's going to really, I think, make a lot of groups think, right, what am I doing? What does it look like? I'm going to have to do something. So I think that will stimulate extra discussion in the market going forward.
Gosh, that's quite a list. Thanks, Annabel.
talking to the Victorian industrial leasing market, I said before that I think we've got really strong fundamentals and we're in pretty good shape. There's been a lull. One of the other advantages we have is the relative affordability when compared to Sydney. So we're hearing a lot of talk that groups will move their national distribution centre from Sydney to Melbourne once leases come to an end there. We haven't seen much transactional evidence, but that's what that's a lot of discussion. But I think the biggest thing that we need is discretionary spend, the economy stimulated. So we need to see some rate cuts to get people spending money, to get inventory coming in containers and a requirement for warehousing again. Yeah, that's probably the biggest need for us.
Yeah, great. All right. Well, thank you so much, Peter Harper, Annabel McFarlane and James Jorgensen. Appreciate your insights and all that data and intelligence.